Hello, everyone. You are watching Smart Capital, the School of Financial Literacy.
It is really great to be here with you all today.
Today, we are taking a deep dive into the hidden fault lines that are currently fracturing our global financial system.
Yeah, we are tracking a massive, largely unseen architectural shift happening in the world of private credit right now.
And we are analyzing this perfect storm of economic pressures that is brewing. But most importantly, we are mapping out how you can successfully navigate these turbulent waters.
Right, because we are looking at a dynamic where the very plumbing of Wall Street is under immense stress.
Before we continue, I'm curious how many of you are already interested in financial education or investing? Let us know in the comments.
I love seeing those responses because, understanding these mechanisms is never about panic. It is about preparation.
Exactly.
When you comprehend how the financial system is truly wired behind the scenes, you can position yourself to protect your wealth.
You can even find incredible opportunities while the rest of the market is, simply reacting to the latest terrifying headlines.
Right. Whether you are an active trader hunting for alpha or just someone with a standard retirement account hoping to outpace inflation.
And outpacing inflation is becoming the ultimate challenge here.
It really is. To understand why, we first need to set the broader macroeconomic stage.
The perfect storm for stagflation.
Yeah, the data we are looking at points directly toward that. For those tracking the metrics, February brought us the worst job market we have seen since the pandemic.
Major slowdowns in hiring.
Exactly. Major slowdowns alongside persistent price increases.
The inflation side of that stagflation equation is incredibly stubborn.
It is?
I mean, even before the recent conflicts in the Middle East, specifically before the United States attacked, Iran domestic inflation was already curving back upward.
Right. And now with the ensuing crisis in the Middle East, global oil prices are surging.
Which naturally pours gasoline on those inflation concerns.
Oh, absolutely. Higher energy costs drive up the cost of manufacturing, shipping, literally everyday consumer goods.
And that brings us to the third and perhaps most critical component of this storm.
Wall Street is beginning to fracture under the sustained weight of these higher interest rates.
The pressure is mounting.
Yeah, and the cracks are starting to show in a very massive, highly opaque sector of the financial world known as private credit.
If you enjoy clear and simple explanations of financial topics like this, give this video a like so we know you want more content like this.
Because this is where the narrative gets incredibly intense.
Okay, let's unpack this. We recently saw BlackRock, the world's largest asset manager, declare that investors can no longer pull their money out of their private credit fund.
They simply gated the fund.
Right, they blocked withdrawals. Why does an institution with trillions in assets under management just lock the doors and tell investors their liquidity is gone?
To understand this, we have to look at the arbitrage happening between regulated banking and shadow banking.
The regulatory gap.
Exactly. That gap is the entire engine of this crisis. When a business goes to a traditional Tier 1 bank to borrow money, they face a wall of federal regulation.
The bank reviews their cash flow, their collateral.
Right, and their debt-to-income ratios under the strict watchful eye of the Federal Reserve.
It is a system built on stringent capital requirements and safety checks to prevent systemic contagion.
But imagine a mid-sized company wants to raise, say, $300 million to fund an acquisition or just keep your operations afloat.
They go to that highly regulated bank.
Yeah, but the bank's underwriters look at their balance sheet and say, no, your debt load is too high, you are too risky for our regulated books.
And going to the public stock market to raise capital for $300 million might not justify the massive legal and structural costs.
Right, so that company is stuck. They desperately need liquidity, but the regulated banks have shut them out.
So they turn to third-party lenders.
Exactly. Entities like Blackstone, Blue Owl, or BlackRock. This is the shadow banking world of private credit.
These third-party private credit companies do not face the same strict capital requirements, do they?
No, or the federal oversight. They are willing to take on the borrowers that the traditional banking system rejected.
But there is a catch.
A huge one. To compensate for that massive spike in risk, they charge exorbitant interest rates.
How high are we talking?
In the current economic climate, we're talking about interest rates floating between 10% and 15% on hundreds of millions of dollars in corporate debt.
Think about it. If a company is too risky for a highly regulated bank, what kind of pressure does a 15% interest rate put on a struggling business?
It is a staggering financial burden.
Mm.
It leaves zero room for operational error.
None at all.
And yet the private lenders were incredibly aggressive in deploying this capital.
Because they need vast amounts of cash to make these massive loans.
Right. So they invite pension funds, university endowments, and everyday accredited investors to lend them money.
Promising them attractive yields, right?
Yeah, usually 8% to 12% a year. But the underwriting standards were astonishingly loose.
How loose?
Well, a recent statistical breakdown reveals that more than 40% of the companies taking these private credit loans already had negative cash flow at the exact moment they signed the paperwork.
Wait, hold on. Let me make sure I'm hearing that correctly.
Yeah.
Almost half of these companies were already bleeding cash,
Yes.
operating in the red every single month before they took on a massive new loan with a 15% interest rate.
Exactly.
How does any risk manager greenlight that? It sounds like a mathematical death sentence.
It really does. And that brings us to the reality of what is happening right now.
Because interest rates have stayed higher for longer than Wall Street anticipated.
Right. So these over-leveraged companies are throwing in the towel. They cannot service the debt, and they are declaring default.
And the domino effect of those defaults is swift and brutal.
When the borrowing companies default, the private credit funds stop receiving their massive monthly interest payments
So the cash flow just dries up.
completely. And when they experience that sudden drop in cash flow, they no longer have the liquidity on hand to pay back the pension funds, retirement accounts, and everyday investors.
The people who staked them in the first place.
Exactly. That is the true reason these massive institutions are freezing withdrawals. They literally do not have the cash.
Imagine you were in this situation. What decision would you make? Write your thoughts in the comments.
It is a terrifying scenario to think you have a portion of your net worth wrapped up in a high-yield fund, and you hit a brick wall when you try to withdraw it.
And the truly alarming part is that gating a fund is never just an isolated glitch.
What's fascinating here is how closely the mechanics of this freeze mirror the early warning signs that triggered the 2008 financial crisis.
Let's look back at the summer of 2007.
Right, Bear Stearns was operating two massive hedge funds, heavily loaded with incredibly risky, highly leveraged subprime mortgages.
And when the underlying homeowners started to default on those mortgages, the funds began to bleed.
Institutional investors panicked and demanded their money back. And Bear Stearns did exactly what we are seeing today.
They gated the funds and froze withdrawals.
Yes.
I remember the media coverage from that exact moment. Wall Street insiders and prominent financial anchors were entirely brushing it off.
Oh, yeah. They were going on television calling it a contained issue.
A localized liquidity mismatch that would absolutely not bleed into the broader macroeconomic landscape.
But fast forward a few months to 2008, and Bear Stearns completely collapsed under the weight of those toxic assets.
Eventually being scooped up for pennies on the dollar by JP Morgan.
That single withdrawal freeze was the canary in the coal mine for a global crash. That historical parallel is why paying attention to liquidity freezes is so vital.
Because when major financial institutions legally block you from your own capital, it means the underlying foundation of their asset valuation is cracking.
Right.
Which perfectly illustrates the cockroach theory of finance.
Coined by Jamie Dimon, yeah.
The theory dictates that when you flip on the kitchen light and see one cockroach scurry across the floor, you can safely assume there are hundreds more hiding in the walls.
Exactly. When a few massive funds start failing and locking up capital, it exposes the reality that systemic, highly correlated problems are lurking just out of sight.
And those problems are deeply interconnected.
The danger of private credit is not confined to obscure Wall Street hedge funds. It is woven directly into the fabric of the broader economy.
Here's where it gets really interesting. Those traditional, highly regulated Tier 1 banks we talked about earlier,
The ones that rejected these risky companies.
it turns out they are holding the bag anyway.
They absolutely are. International financial monitors have recently issued a stark warning regarding this exact dynamic.
The data is staggering. It reveals that banks in the United States and Europe have a combined $4.5 trillion in exposure to hedge funds, private credit, and other non-bank financial institutions.
To contextualize a number as massive as $4.5 trillion, we need to look at how the capital actually flows.
How does that happen?
Well, traditional banks have been extending massive credit facilities, often called subscription lines of credit, to these private credit funds.
So the banks lend the funds billions at a lower, safer interest rate.
Right. And the funds then turn around and lend that same money to the risky negative cash flow companies at 15%.
So the traditional banks thought they were insulated from the risk because they were lending to a massive Wall Street fund, not the risky startup itself.
Exactly. But now that the underlying companies are defaulting, The private credit funds are taking massive losses.
Which means the traditional bank's loans are suddenly in jeopardy.
Yes, and we can even look at the specific institutions carrying this weight. The top exposed banks in the United States right now include foundational names
Like Wells Fargo, Bank of America, PNC.
Citigroup and JP Morgan Chase. These are the pillars of the American banking system.
And they have massive multi-billion-dollar exposure to these unregulated shadow loans.
We can already see the real-world casualties of this dynamic playing out in the corporate sector right now. Take the events of September 2025, for example.
What happened there?
A company called Tricolor declared bankruptcy. Tricolor was a subprime auto lender.
Right.
Their entire business model relied on borrowing huge sums of money from private credit funds to issue car loans to extremely high-risk subprime buyers.
And the subprime auto life cycle is brutal in a high-rate environment.
Very brutal. Because interest rates stayed elevated, those subprime buyers couldn't refinance their expensive car loans.
So delinquency spiked and repossessions skyrocketed.
Yeah, but a repossessed car in a depressed market is worth a fraction of the loan value.
So Tricolor's cash flow evaporated.
They filed for bankruptcy, and they left the private credit hedge funds completely empty-handed.
And Tricolor was not an isolated incident.
No. Look at First Brands, a major auto parts supplier. They faced a severe slowdown in sales due to the very same high interest rates depressing the auto market.
Compounded by internal financial mismanagement, I assume.
Exactly. But despite their glaring balance sheet issues, private credit funds kept extending them lifelines.
Feeding them more debt to keep the lights on.
Right up until First Brands inevitably failed.
Mm.
When a company like that goes under, the recovery rate on the debt is abysmal.
Huge sums of capital simply vanish.
The funds take the loss, and the traditional banks backing the funds suddenly have a hole in their balance sheets.
Which brings up a glaring trillion-dollar mystery. If this localized risk was quietly compounding into a $4.5 trillion systemic threat, where on earth were the regulators?
That is the big question.
The Federal Reserve Bank runs routine stress tests on all major financial institutions precisely to ensure they can survive a massive economic shock.
And in 2025, the Fed proudly paraded the results, announcing that all major banks passed their stress tests.
Projecting an image of impenetrable stability to the public.
This raises an important question. How do you pass a stress test while sitting on a powder keg of shadow debt? The answer lies in the parameters of the test itself. What the Federal Reserve failed to heavily publicize was that they systematically eased the requirements for those 2025 stress tests.
They altered the models.
Yes, making it statistically easier for banks to pass scenarios involving commercial real estate collapses, severe housing market crashes, and broad stock market downturns.
So the bar for survival was literally lowered.
It was. But the most shocking revelation didn't come out until later.
Right. We eventually learned that the Federal Reserve intentionally chose to completely exclude the bank's exposure to hedge funds and private equity from the stress test models.
They deliberately created a blind spot.
What was the official justification for that?
Regulators assumed private equity investments are illiquid and typically held for the long term. So they theorized these assets wouldn't be panic sold during times of acute financial distress.
But that assumption fundamentally misunderstands market psychology.
Totally. When distress hits, liquidity is the only thing that matters. Clients at major asset managers are desperately trying to pull their money out right now to cover losses elsewhere.
Which is the exact catalyst forcing the funds to freeze withdrawals.
Right. Regulators engineered a massive blind spot based on a flawed assumption. And now the banking system has to navigate the consequences of that oversight.
If you're interested in financial education, investing, and understanding how money works, make sure to subscribe to the channel. We regularly break down complex financial ideas in simple terms.
Because when you are operating in a macroeconomic landscape where the central regulators are missing a $4.5 trillion threat, you have to take total ownership of your own financial literacy and strategy.
And taking ownership means filtering out the noise.
Absolutely. The goal of understanding these systemic cracks is not to incite panic or encourage you to liquidate your portfolio.
Markets are cyclical by nature. Recessions, corrections, and even banking crises are historical constants.
The objective is to use this awareness to insulate your capital.
So what does this all mean for your actual portfolio? How do you protect yourself and actively grow your wealth when the shadow banking sector is flashing warning signs?
First, a quick look at the historical data. Over the last century, The market has endured six.
So, diversifying your cash reserves across multiple distinct banking institutions ensures every single dollar remains under that protective umbrella.
Exactly. Once your cash foundation is secure, you can focus on growth.
For the everyday investor looking to capitalize on volatility, there is a battle tested behavioral strategy, ABB, or always be buying.
Right. If your investment thesis is that the global economy and human innovation will be vastly larger and more productive in 20 years than it is today, then short-term volatility is a massive advantage.
When the market dips because of stagflation fears or a private credit unwinding, you need to view it through the lens of a Cyber Monday sale.
The intrinsic value of the companies hasn't necessarily disappeared, but the share price is temporarily slashed.
Your capital suddenly buys you a larger fractional ownership of the global economy.
To execute that always be buying mindset efficiently without the immense risk of trying to pick individual winning stocks, investors turn to broad market index funds and ETFs.
These vehicles allow you to purchase a heavily diversified slice of the entire market.
For instance, an ETF ticker like VTI provides exposure to virtually the entire publicly traded U.S. equity market, balancing your risk across thousands of companies.
And if you want to concentrate on the heavyweights, a fund like SPY tracks the top 500 companies, giving you immediate exposure to the absolute largest profit engines in the economy.
Or, if your risk tolerance is higher and you want to lean into innovation, QQQ tracks the top 100 non-financial companies, heavily weighting your portfolio toward the tech sector.
Tech generally acts as a high beta asset. It surges much higher during the bull markets, but it experiences much more violent drawdowns during the crashes.
The core philosophy of ABB is relentless consistency. You ignore the terrifying headlines and you allocate capital every single month.
That is the essence of a passive broad market approach. It removes emotion from the equation.
However, there is a distinct divergence between passive index investing and active niche investing.
Right. For those already actively managing their portfolios and hunting for alpha, a crisis in the private credit sector presents unique opportunities.
If fears of shadow banking defaults artificially drag down the stock prices of fundamentally sound, well-capitalized regional banks, an active investor can step in and acquire those cash-flowing businesses at deeply distressed valuations.
But to be explicitly clear, active investing requires treating your portfolio like a full-time job.
You are no longer just buying the market.
You are meticulously tearing apart balance sheets, calculating exact exposure levels to these private credit funds, and analyzing loan-to-deposit ratios.
Doing that intense fundamental research is the only way to mitigate risk while seeking outsized returns.
If we connect this to the bigger picture, navigating private credit exposure is only one half the macroeconomic puzzle.
Right. We are also tracking massive structural policy proposals on the horizon that could fundamentally rewrite the rules of global commerce.
Specifically, Donald Trump recently confirmed a sweeping economic proposal intended to completely alter the United States tax structure.
The stated policy objective is to substantially eliminate the modern-day domestic income tax system entirely.
And replace that lost federal revenue with comprehensive tariffs levied on foreign countries and imported goods.
The sheer scale of a pivot like that is staggering to consider.
Transitioning the financial burden of running the government from the income of everyday citizens to a system of international trade tariffs would cause a seismic shift in global supply chains.
It would instantly alter consumer purchasing power, redefine how multinational corporations source their materials, and completely change the pricing architecture of everyday goods.
It is a strictly factual, structural economic proposal that every investor must monitor closely, regardless of political affiliation.
Because the math will dictate the next decade of market returns.
It is a phenomenal reminder of why remaining hypervigilant and financially literate is so crucial.
To summarize the landscape we've mapped out today, we're tracking a highly unregulated private credit market, heavily burdened by 10% to 15% interest rates,
Where severely overleveraged companies are beginning to default.
which is forcing massive asset managers to freeze investor withdrawals to survive the liquidity crunch.
We also exposed the $4.5 trillion tether connecting these shadow funds directly to our foundational traditional banks.
This is a massive systemic vulnerability that the Federal Reserve actively ignored during their recent stress tests by intentionally easing the parameters and turning a blind eye to private equity exposure.
Yet armed with this data, you have the tactical advantage.
By verifying your protective limits, utilizing the always be buying framework, and staying entirely objective about market data, you can transform systemic fear into a calculated long-term wealth-building strategy.
Before we wrap up, I want to leave you with one final thought to ponder.
Okay.
We just analyzed the precarious nature of a $4.5 trillion private credit bubble, and we examined the proposed macroeconomic pivot to eliminate domestic income taxes in favor of sweeping global tariffs.
Both massive events.
Imagine the friction if those two massive events collide. If the private credit bubble were to truly burst, severely restricting corporate borrowing, at the exact same moment the economy transitions from income taxes to import tariffs. How would that unprecedented simultaneous shock fundamentally rewrite everyday corporate profitability and the final prices you pay at the grocery store?
It is a complex collision of forces worth deeply analyzing.
Thank you for watching this video all the way to the end.
If you enjoyed this discussion, subscribe to the channel, leave a like, and we'll see you in the next breakdown.